During this short session, we will explain the differences between creating a finance lease versus an operating lease, and using asset valuations or an effective interest rate. Let's start with differences between the operating and finance lease. When you create a new lease, from the first drop-down menu, you select the lease type. Here, I've selected finance lease. I complete the name, description and reference as appropriate, and in this example I will also create the lease using known asset values, which should not be confused with total cost of payments made to lease the asset. When we use the known values, nettTracker will calculate the implicit interest rate based on the asset values, any payments made before the lease commences, and regular payments expected to be made throughout the lease term. We complete the date boxes and select the required asset group which needs to be in place beforehand. For a finance lease, the interest on the lease needs to be debited to the appropriate account in the profit and loss. We also select the liability account for the lease or create a new one if required. Finally, we can select an additional location or tracking category if required before saving. Before we create an operating lease, we first need to check the asset group mappings for operating leases. Depending on the accounting standards followed, you can treat an operating lease in the exact same way as a finance lease. However, if the lease is being fully accounted for as an operating lease, there is an expectation that the lease cost of an asset will be reflected straight line in the profit and loss. So instead of mapping to depreciation expenses, we can instead map to lease expenses. When we create a new lease, this time we'll select operating lease from the drop-down. We then enter all of the values and dates exactly as we did before. The only difference is selecting the asset group, and the interest cost of the operating lease needs to be posted to the lease expense account in the profit and loss. So far, we have created two leases using the same values and dates, but the distinguishing factor between the operating lease and the finance lease is how the costs are reported in the profit and loss. After processing the periods for the year, we can see how the profit and loss is affected. The finance lease will charge depreciation straight line over the lease term, and interest will decrease as the loan balance decreases. For the operating lease, the profit and loss will report the lease costs on a straight line basis, which is a combination of the interest and the depreciation. In both of those examples, the market value and the expected value at the end of the lease term was known. However, it's not always that easy to obtain market values, especially when it could be an operating lease for a property. In those situations, instead of using values, we can use an effective interest rate. This rate is typically the type of interest rate you would expect to be charged if you needed to borrow funds to pay for the lease. When we created both lease types using the values, an implicit rate of interest was calculated for us. We will use that same interest rate to see how the values compare. So again, we'll create another operating lease, but instead of using the market value, we shall enter an interest rate. We will complete all of the other fields exactly as before, and you can see the field for the expected value at the end of the lease is greyed out. Once saved, you can see there is a small difference between the calculated lease liability value using the interest rate compared to when the asset valuations were used, which is down to roundings in the interest rate initially displayed. In this session, we've covered the key differences between operating and finance leases in nettTracker, and creating leases using current market values or effective interest rates.